What we're going to be going over here is not-for-profit accounting for colleges and universities, and this is where you're going to have private versus public colleges and universities. They would have different accounting here for the external purposes or external reporting purposes here, difference between public and private here, but both would have similar accounting for internal purposes here, and that's what we're going to be looking at here. We're looking at the accounting here internally here for these colleges and universities. Now, college and university accounting is really similar to other not-for-profit organizations for setting up donor restrictions here on dollars received. Those would be external restrictions. An example would be for like grants received and how the money here on those grants that were received, how it can be spent. And you're going to account for these asset resources by setting up different fund asset categories, same as you would be doing for not-for-profit organizations. And what you're going to have here is you're going to, on these asset categories, you're going to have different restrictions here. And really those restrictions are set up as external restrictions or donor restrictions. External to the university itself here. The donor sets up some restrictions, and the restrictions is how the funding here should be spent. Either the purpose here of the funding or the timing of that funding. Okay, so what you're going to do here, same as for not-for-profit organizations, you're going to have to determine the different funds you have for the universities here, and then based on those funds you're going to have to determine your fund asset categories. So first looking at our funds, and we'll go through a brief explanation of these just in our next discussion here, but just for universities here and colleges, you're going to have these basic funds here. You're going to have the current unrestricted fund, current restricted fund, some loan funds here, plant fund, land and buildings. You're going to have an endowment fund and an annuity life income funds, and then agency or custodial fund here. Okay, and then for each of those funds here, you have to classify your fund asset categories, either as permanently restricted here, and this is how, when you talk about restrictions, this is the it's restrictions by the donor here, or external restrictions here to the college or university. The permanent restriction is saying it really the restriction is set permanently here on how you can spend those dollars that were contributed, or any resources that contributed permanently. The donor here sets a restriction on it. And then you're going to have a temporarily restricted assets here, and then unrestricted assets. And we're really looking at net assets when we're talking about these fund asset categories. So what's going to happen here, you're going to really have to be reporting these balances here in your reporting here for the end of the period reporting, and you're going to have to make that reporting based on your restrictions are either permanently, temporarily, or unrestricted assets. And what we're doing with, we really work with this temporarily restricted asset account here. And this is the case here where you're going to be doing a lot of reclassifying from the unrestricted after the restrictions here have been removed here, then you're going to have to reclassify it as to unrestricted assets. So you're going to have to reclassify to the unrestricted net assets here after the restrictions expire. And again, those would either be a donor stipulated time has elapsed or the purpose has been fulfilled. So that's the big thing here when we're talking about these not-for-profit universities here, and or private and public universities. So we're going to have to be doing a lot of reclassifying here between our temporarily restricted net assets and our unrestricted net assets. And really, again, the restrictions here is on how those monies should be spent. Either you are going to have some permanent restrictions that are going to be permanently set on those net assets, or temporary restrictions where either the stipulated time has elapsed or the purpose has been fulfilled. Then you can reclassify those assets into the unrestricted net assets. And that's an important point here when you talk about not-for-profit accounting. And then further on here, these funds here, these funds that we looked at, they really are structured around the rule here of restricted dollars or money. So if you have restricted funding dollars here, it's received, you do not recognize a realized revenue here or an expense until after the dollars here are spent for the intended purpose. And when we talk about revenue here, we're talking about the realized revenue here. Okay, so now let's go up here and let's just go over here and look at a brief description of each of these funds. So in our university funds, it would be our colleges as well, what are the funds here? So we're going to have in that current funds group here, we're going to have two of them. We're going to have the current unrestricted fund. That's where you have unrestricted dollars here, and that's like all the revenue coming in for tuition. And this is where you account for your day-to-day operations. So you're not going to have any restrictions here on how those dollars are spent. Then you have the current restricted fund. That's where you have restricted dollars here. Those would be like federal grants and so on here. And then we move down into our plant funds, and we really have four of those here. So first, you'd have the unexpended plant fund. That's where it accumulates dollars here for fixed assets. It does not carry any fixed assets in that fund. Now you have the investment in plant fund. This is where you carry your fixed assets and also your long-term debt on those fixed assets. And then you have your renewal and replacement fund. That's where it accumulates dollars for capital improvements. And then lastly, you'll have your retirement of indebtedness fund here. This is where you're going to accumulate dollars to service the debt. And then we have the annuity and life income funds, and we have two of those here. The annuity fund, that's where the donor gets a set number of annuity payments, and then the university gets the principal at the end of those set number of payments, or years, or some years here on the annuity fund. And then you'd have a life income fund here. That's where the donor gets interest plus any dividends until the donor dies here. Then the university gets to keep the principal. And then you'd have your agency fund here. That's where the university acts as an agent for someone else. This is where dollars pass through to like student recipients here on Pell Grants and so forth here. And those would be federal dollars here. University only acts as an agent, as a pass-through agent. Okay, and then you have your loan funds. This is where you're going to have temporary loans to students, faculty, and staff. And then you have your endowment funds, and you really have three types of endowment funds here. This accounts for the dollars donated to the university. First, you'd have a pure endowment. That's where the original principal remains intact. And then secondly, you might have a term endowment. That's after a period of time, the principal is used here. And then you'd have a quasi-endowment. This is where the governing board of the university sets up an endowment for their own purposes. Okay, so next we'll look at how some of these funds are used and how they operate. Now let's just go over our current funds group, and those would be both restricted and unrestricted current funds. So looking at our current unrestricted funds, those would be unrestricted dollars here, and they account for the current assets available to cover current operational costs here, and there wouldn't be any limitations on how the dollars are spent on the resources received. So what we would do for our entries here, we both have unrestricted revenues here and unrestricted cash, and also we'd be paying our expenses out of those unrestricted revenues. So let's just say, for example, here in our cash account, we would have it titled here as unrestricted. And let's say we received some cash here, and we would have debited our cash account for whatever our receipts would be here. And we'd also have to include any accounts receivable and any allowance for any uncollectibles here when we're talking about those revenues that we're going to be recognizing. So then we've debited our cash for whatever our cash receipts were here. Then we'd go over into our revenues account. Again, it would be titled unrestricted revenues here. Credit our revenues here for whatever amount we received here. And those would be current dollars here that are unrestricted. And then let's just say we paid some expenses out of those cash receipts here. So our cash account, all we do is credit that here for the amount that's paid, and then our expenses, we'd go in and debit or increase our expenses by our expense account here as unrestricted expenses here. And again, these are just straight up entries here. There's no restrictions here on those fundings received. So we can pay our expenses out of the unrestricted revenues in unrestricted cash. And the point is here, there's no reclassification since those dollars were unrestricted. We don't have to reclassify them from restricted restricted dollars to unrestricted dollars. And our revenues here, those would be like student tuition, government appropriations, unrestricted endowment dollars here and contribution dollars here, and other investment dollars here. And then for expenses, those would be like the instructional expenses here, research, academic support, student services, student aid, and plant and maintenance operations. Okay, so that's for our current unrestricted fund. Now let's go up and let's look at our current restricted fund. This is where we're going to have some restricted dollars, and it accounts for the current assets available to cover current operational costs, where some limitations exist on the resources received from an external entity like a donor here. Now again, here this is where we're going to use the same revenue and expenses accounts here as we did in the unrestricted fund group here, but there's going to be a restricted current fund. We're going to have restricted current fund revenues, and they're going to arise from like government grants, contracts, private gifts, and endowment income, for examples here. And then one note here, our loan funds would be treated similar to grants here. Okay, so this is the case here where the rule for unrestricted or restricted dollars comes into play. So if you have restricted funding dollars that's received, you do not recognize any revenue or expense until after those dollars are spent for the intended purpose here. It also could be a time limit that was set out on here, and after a certain time you could also spend those dollars here. But those would be our resources. This is our resources where they're really expenditure driven. So for a brief little example here, say you receive a cash gift here and it's temporarily restricted here by the donor to be used here on student scholarships, and then when the scholarship dollars here are granted, then we're going to have to be able to recognize it as expense and unrestricted revenue. So what you're going to do here, you're going to have these accounts set up. Of course, you're going to have some cash account or cash account here, and you're going to have, this is where this comes into this reclassifying your revenues. This is where you're going to have a account. You're going to have to set up the reclassification out and reclassification in to transfer your cash, restricted cash, to the unrestricted cash, and take those revenues that are going to be temporarily restricted and move them into an unrestricted category here, asset category. So let's just look at our little example here. We have some cash receipts. Say we had that gift here was for $5,000. So debit your cash account here for $5,000, and this would be restricted cash. Really, you're going to have two different cash accounts. I'm just showing them tied into one here, but you're going to have restricted cash here on that donation or that gift that was made here, and then moving over to your revenue account, you're going to have it titled here as temporarily restricted for the purpose here that the donor had, those student scholarships. So you'd credit your revenue account here for $5,000, but it would have to be titled here temporary restricted revenue. And then come along here when the scholarship was actually granted to the student here, this is where you're going to do your reclassification here of those of the restricted cash and your revenue that's temporarily restricted. So before we actually recognize the expense here on that scholarship here, what we would do here, we have to set up our reclassification account. So we're going to reclassify our revenue to unrestricted here, and then we're going to realize the expense. So here's the case here. Let's just say the reclassification out on that it would be titled temporarily restricted here, assets here. We would debit that or reduce our reclassification out here by $5,000. That's going to release those that restricted cash here to pay for that student scholarship. So debit your reclassification out account here for our temporarily restricted dollars here, and then for that transfer out, and then we're going to have set up the account here reclassification in to the unrestricted revenue or dollars here. So this is the case where we credit our reclassification in here for $5,000 for the transfer in here. So we have had to do this reclassification of our revenue here. Our reclassification out, we would debit that here for $5,000 here to transfer out the funding here, and then we reclassification in, do our reclassification in here to the unrestricted dollars or funding. That's where we're going to transfer it in here, and we're credited for $5,000. And then after we've done that reclassification, then we can actually pay out our cash here. And this would be now unrestricted cash. We would credit that here for $5,000 for the cash, that cash that was paid on for the student scholarship here. And then we could go down to our expense account here. Again, it's unrestricted expenses here. We debit that here for $5,000 for the payout. The only thing is, you want to note here, when you're talking about those current restricted funds, whenever you have to, whatever your restriction is here in your revenue and your cash, and the cash that's related to the revenue here that's received, when you actually make those payments here, you from a temporarily restricted, say it was a temporary restricted assets here, you have to do your reclassification out here from the temporary restricted asset, temporary restricted asset here, to reclassification in for the unrestricted asset. Okay, so that'll take care of our current funds groups here, restricted versus unrestricted. Okay, now let's look at endowment funds. This is where we account for the dollars donated to the university, and really have those three endowments here. They could be a pure endowment. That's where the original principal remains intact. You can have your term endowment, so that after a period of time the principal can be used up. And then you have a quasi-endowment. This is where the governing board of the university sets up an endowment fund here for their own purposes. And it would be unrestricted. That's the key here. Because it's internally restricted, the governing board can change their mind here on the endowment. Therefore, we would call it unrestricted. Key point. Now, income earned from a restricted endowment, the resources is recorded directly in either of the funds that we'll look at here, and it's really based on donor specified use of those dollars. So restricted endowment here, any income earnings can go into the restricted current fund, a loan fund, the endowment fund, or a plant fund. Now, income which there is no restrictions on is recorded directly in the unrestricted current fund. So with restricted income earned, it can go into any of these funds here, but if there's no restrictions, then it would go directly into the unrestricted current fund. So key points that we'll just go through here. Just for a pure endowment here, this is where the original principal remains intact. Of course, you'd have your investments, and it would have to be listed under a pure endowment. Just say we had a $100,000 debit amount in those, and those would have to be restricted investments. And then we'd recognize revenues here, but it would be permanently restricted revenues here, credited, say, for $100,000. So pure endowment, the original principal here remains intact. Now, with the term endowment, this is where after a period of time the principal can be used. So after it expires, you can make cash available. And the only point you want to make is that with this term endowment, you have to go through that reclassification out here from the temporarily restricted asset here to a reclassification in here to the unrestricted asset. So that's the only point we want to make here when we have these term endowments, when after a period of time the principal can be used. So just reclassification out, debit or reduce your reclassification out here for the transfer out, and then reclassification in to the unrestricted account here. Reclassification out was from the temporary restricted account. Reclassification in goes to the unrestricted account here. And that we would just credit here for $50,000. So the term endowment, this is where we can use up the principal, but you have to make this reclassification before you do that. Okay, now let's go and just look at the endowment fund where we report our investments or our assets. And the key is you're going to be doing your reporting here at the fair value. Now, that would be at the contribution date here of any endowment receipts here. And we'd also have to include any changes in fair value on that contribution or those endowment in the endowment investment here. So let's just look at the case here for this fair value here. So let's just say our investments here are carried at $412,000. Just say that was their present value here when they were donated. And then just say at the end of the year here, we have to come up and we have to look at the changes in the fair value. We have to record the fair value at the contribution date and any changes in that investment. So let's just say we were sitting at $412,000. Now we reassess it, and then it's sitting at $400,000. So to account for that, we'd have our investments account here for this endowment fund here, and then any increases or decreases would have to go against our investment account here. And then outside of our investments account, we're going to have a net depreciation for this fair value investment for any reductions here in our fair value about that investment. And then we'd also have an account here, net appreciation for fair value, for the fair value investment, any changes or net increases in our investment account. So let's just say we had that $412,000 sitting here in our carrying value or in our investments account, and now the fair value we now say at the end of the year is $400,000. So we make our adjustments directly to the investment account here, credit it here for that reduction here at $12,000. Then the debit in this case is going to go to net depreciation for that fair value adjustment because it went down from $412,000 to $400,000. So debit your net depreciation here for $12,000. This is just keeping track of your increases and decreases in your investment account because you have to make those fair value adjustments for each period. So that's going to reduce our investment account, and then our investments here, the carrying value would be sitting at $400,000. We had the $412,000 here, then it was reduced by $12,000 here for the fair value adjustment. Now we're sitting at $400,000. Now, had the investment went up by $12,000 here, then we would have debited or increased our investments account here by $12,000. That would have brought it up to $424,000. But then we'd have had to go in over to our net appreciation account here for any increases that we'd have in fair value. We'd just credit that here for $12,000. So we have to make that fair value adjustment here, either adjusting your fair value down for any decreases in your investment or adjusting it up for any increases. So you make your adjustments directly in the investment account, and then you account for them as any increases or decreases here outside of the account. But the point is, all investment income, including the changes in fair value here, are reported as revenue in the operating statement. Okay, so in the second case here, let's look at gains and losses on the sale of endowment investments. So gains and losses really are based on the fair value in the investment here, not its cost. So for example here, say the endowment investments here are sold for $80,000. Just say that was the original cost, and the fair value is actually $100,000 at the sale date here. Now this is where we're going to use the fair value to determine any gains or losses that would be realized. So in our investment account here for the endowment investment, let's just say we sold them here for $100,000. So we credit or reduce our investment account here by $100,000. The fair value here of the investment, not its original cost here. So credit that here for $100,000, and just say, for example, here we received $105,000 cash, and this would, our cash account here, it'd either be restricted or unrestricted. It depends on how that endowment was set up here by the donor. So let's just say, just whatever it is here, we would debit our cash here for $105,000. That would be what we sold those investments at, and then we go and recognize here a gain on sale, and we'd have to check here whatever restrictions the donor had on that investment or on that endowment here. So in this case, just gain on sale, we credit that here for $5,000. We use the fair value here of the investment at the date of the sale here to determine any gains or losses. Okay, so there's the case here where we had a gain. Now say we have a loss here. Sold it, or cash received for that $100,000 fair value of that investment, we only received $95,000, so we have a loss here. Debit our cash for $95,000, and then we'd go over and we'd have to have our loss here on the sale. We would have to debit that here for $5,000. Again, we have to check our restrictions and how we're going to handle that loss here. Sale losses, we would have, in this case, received that less money based off the fair value here. Cash versus cash receipts versus the fair value. So what we want to look at here is you use the fair value here to determine any gains or losses here on those annuities, and you have to check for any donor restrictions as far as any gains and losses, and you would report gains or losses as revenue. Again, either unrestricted versus restricted. And those would be net realized dollars here on any gains or losses. Okay, so that'll summarize our key points here on those endowment funds. Now let's look at annuity and life income funds. Now an annuity fund here, that's where the donor gets a set number of annuity payments. The university gets the principal after the set number of payments have been made, or a time designation, say in years. And then secondly, a life income fund, that's where the donor or any of the donor's designated beneficiaries here gets the interest plus any dividends here until they die. Then the university gets to keep the principal. Now for the life income or annuity, first off, you report it at their fair value at the date receipt here of the donated dollars here for that life income or annuity here. And secondly, you report the liability for the actuarial present value of those annuity payments. And then thirdly, each payment date, you reduce the annuities payable here, and the liability is adjusted to the amount equal to the present value. So just going through a really basic example here. Say the university sets up a life annuity based on some donor contributions here. So the donor contributes $50,000, and they're going to receive in this example $3,000 per year here for the rest of their life. Thereafter, once they die here, the principal can be used up for student aid. So let's just assume here for this annuity, the estimated life is going to be 15 years here for the donor, and there's going to be an 8% interest rate assumed here on this annuity. So what you're going to do here, you're going to have to set up your cash account here for the annuity for that amount of the donations. Let's say here it's $50,000 for our example here, the amount donated. Debit your cash here for $50,000. Now your annuities payable, that's your liability, and that has to be based on the annuity's present value here. Cash was the fair value here, but the annuities payable, that's going to be paid out here as a liability to the donor here, has to be set up as its present value. And with the if you go through the numbers here for that 15 years, 8% interest, you're going to get a present value of $25,678. So credit your annuities payable as a liability for that amount here. And then you recognize as revenues here, that's again temporarily restricted revenues here, is the difference between the cash donated of $50,000 here and your annuities payable here of $25,678. That's going to give you revenues here. You credit that here for $24,322. So that's really the excess here between your cash that's received and the liability or your annuities payable. Okay, so now comes along the year here where we're going to have to make the first year adjustment to this liability or our annuities payable, and that's based on the interest that we have here. So let's just say we have the present value here of $25,678 times that interest rate of 8%. That's going to give us $2,054 here in interest that we have to adjust our annuities payable by here. So credit our annuities payable here or increase it by that interest amount here, or interest that we have as interest expense for $2,054, and then the debit is going to go against interest expense here for the annuity. Debit that here for $2,054. That's that adjustment here, the adjustment that you had to make here for the first year, and then the actual payment that's made to the donor here of this annuity, or this annuity that was set up for him. You would take your cash account here, credit that here for $3,000 for that actual payment, and then your annuities payable, you would just debit that or reduce your annuities payable by the amount of that payment here, $3,000. Okay, so that's just the basics here for this life annuity that we looked at. Just have to go through these. Set up your payable here based on the present value of the annuity itself, and then you have to make adjustments to that annuities payable or that liability each year here for your interest expense. Increase it for the interest expense that you'd recognize each year here, and then you'd reduce it for the amount that's paid out for that annuity each year. Okay, so that's just the basics. And then the other thing here is when these annuity payments or the life income payments actually cease, that is, they no longer have to be paid out here, then the principal is transferred to whatever fund the donor has specified for this annuity. Okay, so that's just the basics here for looking at this annuity and life income funds. Okay, so that's the summary.